This week is actually very important for the dollar because we have the Fed's preferred measurement of inflation. What does that mean for the greenback? Guys, Ken Chigbo back with another E8 market fundamental update. Let's jump straight into this video. So everything is still very much centered around the dollar and the United States right now in the markets. Now, before we dive deep into the dollar this week of what we've got, how we're shaping up, I want your attention. If you look at markets, right, across major and minor FX, a lot of pairs are still very much range bound. There's a lack of real firm committed direction. And the reason being for that, traders, is because markets need, okay, in my opinion, markets really need that growing economic and monetary policy divergence. What does Ken mean by that? Ken means, in terms of on an economic level, we really need to see a large outperformance or an underperformance from one economy versus the other. Then on a monetary policy level, we need to see a central bank cutting aggressively, dovish action in comparison to another central bank that may not be cutting as fast, right? To create that divergence. With that divergence then comes yield differentials, right? So if we've got one central bank offering higher interest rates and the other much lower, if you measure up those currencies, obviously one currency, i.e. the central bank that's keeping rates higher in comparison to the one that's cutting, their currency is going to have the edge over the other one. Now, obviously, on a level of foreign investors, right, when we're talking about foreign investors, remember, they're seeking yields. Which central bank is offering higher rates? Where can I go and invest my money and get a higher yield rate of return on my funds? Because that then dictates the flows, the money flows. This investor will then sell their currency and buy and go and invest in the economy that's offering higher rates. Does that make sense? So there'll be more demand for that currency. So that's how we're going to get, that divergence. That's what markets need. And we're just at this level playing field right now across the board with a lot of major central banks. Now, look at my screen here with Dixie. You can see the dollar index. We finished in minor green territory, minor positive there. It was generally a week of very much consolidation, pullback after. Remember, just a quick recap. We had this heavy selling pressure for the dollar because we had signs of disinflation across PPIs and CPIs, okay? So markets getting ready. They were warming up for rate cuts. They're pricing at least 2 rate cuts to come from the FOMC now that we're seeing progress on disinflation. And then also, remember, those retail sales last week as well, or the week before last, were poor, okay? So if we got poor performance in retail sales, it means obviously we're getting ready for, a bit of a slowdown in consumer spending, slowdown in consumer performance. So obviously inflation's going to start to come down. Okay. Now, if you look here in the latest week, just want to quickly show you. So we had PMIs, right? I said this week we needed to see signs of cracks in the economy, but we didn't. The PMIs in the form of manufacturing and services were both better than expected, better than previous, good numbers there, which did, knock markets' confidence of potentially getting those rate cuts. Now, if you look at the CME watch tool, remember last week, we were above 60% probability that we're going to be getting a rate cut from the FOMC at the meeting in September. Now, if we look at the latest expectation, the probability has dropped down to 49%. So it's 50-50 right now. Those odds have declined just given that latest week of data. If we look in November, also declined down to just 60% chance. Remember, this at one point was like 80-90%. December was dropped down as well. What were we at in December? 80%, where this was like 90%. So markets are just umming and ahhing right now, trying to suss out what's going to happen and if the FOMC are going to deliver. Now, just on the talking point of FOMC, last week we had Fed Governor Waller, and he just said he wants several months of good inflation data before they start lowering rates. Okay, and obviously we've only just seen that a couple of weeks ago. Remember, signs of disinflation, PPIs and CPIs, we're only just seeing it now, but they want several months, he's saying. So, potential knockback there for the markets in terms of rate cut bets. Now, if we look at the dollar here, obviously on the weekly, we didn't really do much. We're broadly flat, minor positive. On a daily, this is really important for us to note. Remember before House said we had a breakout of this ascending channel structure that had been supporting Dixie to the upside. Remember, Dixie had all this edge here before. Why? You guys know why. It had all this edge because markets were like, look, data is solid from the United States. Look, FOMC are going to be creating this massive divergence on a monetary policy level. They're going to have rates higher for longer, okay? But obviously, it's been losing edge because of signs of disinflation in the United States. So we had a breakout of this range. And now you can look how we're forming this potential bearish flag for the dollar index, as you can see, and a big retest actually there of that channel. Look at that. And so far, rejection, as you can see there on Friday at that closure. So it does potentially still remain vulnerable right now. This week, we're going to be keeping an eye on the Fed's preferred measurement of inflation, which is PCE. All right, we drop down here. That'll be due on Friday, and it's expected to show further signs of disinflation to come down to 0.2% from 0.3%. Now, this is very, very important. If we do get that number coming out lower, it will add fire again, fuel to the fire for those rate cut bets. And obviously, dollar will come under some heavy selling pressure. Now, before that, obviously, we'll keep an eye again. Back to my point of last week, where markets just want to see cracks in the economy. Obviously, we didn't see that in the PMIs. But we'll keep an eye on consumer confidence. Is the consumer getting less confident? Because if the consumer's getting less confident, remember, the consumer makes up a big part of the economy. These guys are out spending their money. If they're not confident, they're probably going to be wanting to spend money, right? They're going to be sitting on their hands. They're going to be biting their nails. They're going to be worried. And that's not good for economic stimulation. So if there's a slowdown there of consumer confidence, that could potentially be dollar negative. We'll keep an eye on the prelim GDP numbers, right, from the United States. Okay, expected to cool down, understandably, because we have seen a bit of an economic slowdown. Depending on how slow this number is, below expectations, obviously that's going to dictate dollar potentially to the downside. So be it with unemployment claims as well. Unemployment claims last week was better. That was also another thing that helped, that coincided with those better PMI data as well. That's expected to pick up to 218,000 jobless claims. All right, and we'll also keep an eye on the GDP price index, which remains elevated at the moment. It's still the prices of the goods and services that make up that GDP number. Is this still inflationary? If it's not, okay, if we do see this number coming down, bear in mind that will see dollar weakness as well. And it will just potentially go nicely hand in hand, okay? The technicals will go hand in hand with these fundamentals, potentially with that rejection there of that channel of the dollar index. And lastly, we'll keep an eye as well on pending home sales data as well. Are we getting a decline in pending home sales? Because that's somewhat disinflationary as well. If we're not getting home sales, pending home sales, then, you know, obviously consumers are tightening up. Bit of an economic slowdown, so on and so forth. So another big week for dollar and obviously market pricing with those rate cuts. This week is also important for the euro. Again, with inflation, we do have inflation data from both Germany and the Eurozone. It's important that we look at German CPI and German inflation because Germany is the largest economy within the Eurozone. So they have a significant part to influence any sort of data when we're looking at the Eurozone and when we're considering where the euro is going in terms of direction. Now, right now, with regards to euro, again, it comes down to the talking point of central bank. Markets are trying to suss out how many cuts are going to be delivered from the ECB. Now, it is expected and it's priced in that we're going to get a 25 basis point cut, a 0.25% cut from the ECB at their meeting in June. That's priced in, but it's what they do after. How dovish are they going to be after that decision? And remember, I keep saying about this monetary policy divergence. Which central bank are we going to get it from first? Who's going to be cutting faster? Who's going to be the most dovish? Okay, so this data is very important in potentially shaping up those expectations as well. Now, look at my screen here. On Wednesday, okay, the 29th of May, which is my birthday, by the way, guys, don't forget it. 29th of May, Ken's birthday. We've got German CPI data expected to cool down this inflation to 0.2% from previous to 0.5. So if this does come out lower, you can expect to see a potential pullback, a potential weakness in euro versus dollar, and maybe euro versus PIS. Because remember as well, don't just fixate on one potential pair where there's maybe a balancing act at the moment, because, you know, we're trying to suss out what the FOMC are doing. We're trying to suss out what the ECB did. You know, you could potentially look at doing that same analysis across other pairs as well, okay, other currency. But anyway, if that does come out lower, obviously we're going to see weakness. If it comes out higher, euro's going to continue its move to the upside, having its edge against the dollar, which we'll look at in a moment. We'll also keep an eye on Spanish CPI. It's a decent sized economy. Inflation expects to remain inflationary at 3.7%. All right, again, if it comes out lower, you know, Europe will lose its edge. And then we'll look at the Eurozone core CPI as a whole, expected to remain sticky at 2.7, and year-on-year expected to pick up to 2.5% from 2.4. Now, you guys know, higher numbers, Euro pushes to the upside. Lower numbers, Euro weakens. If we take a look at Euro here, right? By the way, of late, the ECB has been trying to push back on being dovish after June, okay? They want to assess data, and obviously this is going to be very important shaping up where euro goes. Now, if we look at euro as a whole, you know, remember we were structured to the downside. We're essentially printing lower highs and lower lows, you see. And then effectively not long ago, you know, we broke out of this structure with some thanks to that dollar losing edge as well. We broke out of this structure, a nice little breakout. We wicked them, retested that, and then pushing to the upside. And you could almost look at this as an inverse head and shoulders, potentially left shoulder, head, and then maybe a right shoulder forming here, potential bullish flag, subject to a breakout to the upside. And obviously that is very much dependent. Remember, this is how fundamentals dictate where the price goes. Very much dependent on the CPI this week and also what happens in the United States, as we've covered with the dollar. So sort of keep that in your mind as well. Very important inflation data this week. Focus also on JPY this week with, again, inflation data in the spotlight. Now, you would have noticed with yen at the moment, it still remains very much on the back foot. We're seeing a lot of yen weakness. Why? Well, despite the fact that the BOJ finally moved out of offering negative rates and rates are no longer negative in Japan, the yen has continued to weaken, okay? We'll continue to see outflows from Japan and inflows into other major currencies. You have to remember from a macro perspective, in Japan, rates are still nothing, okay? Japanese investors are not going to get any yield in Japan. But what these guys do, and have been doing it for many, many years, is they borrow in Japan. Because remember, interest, okay, in Japan is nothing. So they can borrow money for, essentially, it doesn't cost them anything. Go and borrow that money, and then these investors go and invest elsewhere internationally, in the likes of the United States, in the UK, in Canada, in the Eurozone, in Australia, New Zealand. You get the point, because these guys are offering a higher rate. So we get this flow, this outflow from yen, weakness in yen. So people have to sell their yen, so the demand for yen falls, and then inflow into dollar, inflow into GBP, inflow into CAD, so on and so forth. Their currencies will strengthen because they want to go and get a yield where these other central banks are offering higher rates. These other economies have higher interest rates. Now, if you look at my screen here, we will be keeping an eye on this data, all right? Got Ueda speaking, Bank of Japan governor there. We have Bank of Japan core CPI, which is expected to remain at 2.2%, which is, they want inflation around the 2% mark. They want it a little bit above. We got Tokyo core CPI as well, expected at 1.9% to pick up, all right? And other data points in the form of unemployment rate, industrial production, retail sales. All of this is important right now for yen, okay? And Japan as an economy at the moment is a little bit fragile. There are debatably dealing with a potential recession right now. The central bank wants inflation to remain around that 2% mark because that's seen as where price stability is at. They don't want to rush to raise rates further because they do risk inflation falling. Remember, for many years, Japan suffered with deflation. Now, if you look at my screen here, I was covering this before, how we left these wicks on these monthly candlestick. This is GJ, for example, and we were likely to go and fill those. Same here with Euro Yen. We left these wicks and we're filling them. You can see that across the board, CAC Yen as well, going for a potential push there as well. And for a brief moment, when the BOJ did decide to act with moving out of negative rates, when the Japanese officials were trying to intervene into the currency markets, prop up the yen from falling, because that's a problem as well for them, which didn't have a lasting impact, right? This is all the problems that they're dealing with, and everything is stacked against the yen still right now. Unless something drastic changes where they come in and they start hiking left, right, and center, with rates being more aggressive, more hawkish. Otherwise, Japan, the JPY, does remain vulnerable. Now let's round up as a collective for both AUD and CAD, right? It's still the talking point of when is the respective central bank going to start cutting rates. There's a particular set of data, key economic data points that we're looking at, and we have a couple of those from both Australia and Canada. When is, in Australia, the RBA going to cut rates? And when in Canada is the Bank of Canada, BOC, going to be cutting rates? Now, firstly, starting off with Australia, right? At the last decision from the RBA, they were very much neutral. They said that we could hike rates, we could cut rates, all right? And obviously, a lot of that comes down to CPI. CPI, if you look here in Australia, has remained sticky, has remained elevated. You saw at the last reading, it picked back up to 3.5%. So it is sticky. This latest reading expects to cool down to 3.4%. Now, depending on how much and if it cools, that's going to dictate Australian dollar. Now, remember what I said before earlier in this video as well. It's pick your pairs wisely. Pick which currency versus the other one you're going to trade. Because, for example, with Aussie dollar, you could measure it up GP against Aussie or CAD or Aussie CAD, so on and so forth, right? This is going to dictate edge. Who has the edge? If Australian CPI remains sticky, Aussie dollar is going to remain propped up versus some of its peers, right? Because at the end of the day, the RBA is just not going to budge. Remember, they said they could hike, they could cut. So depending on how this number comes out, it's obviously going to dictate those flows into Aussie dollar versus some of its peers. Or obviously, if it cools quite substantially, all right, much lower, then you're going to see Aussie lose edge. On the other talking point for Canada, we're going to keep an eye on GDP. Canada as an economy is starting to show cracks. Okay, look here, the previous reading in Australia, in April, 0.2%, lower than expected, lower than previous. Now, this reading this month expected zero growth, 0%, nothing, versus the previous of 0.2. Now, the Bank of Canada are on the verge next month of potentially cutting rates. It comes down to potentially how much are they going to cut by? Are they going to cut by 25 or could they cut more? And then after that decision, with that statement, how many cuts are potentially coming? How dovish are you now, Bank of Canada? We're seeing potentially low growth, disinflation. How dovish are you going to be now with incoming rate cuts? Because that's going to dictate as well how CAD performs versus some of its peers. So plenty of key economic data points across the markets this week to keep an eye on, guys. Other than that, have a blessed trading week, and I'll see you on the next one.